Hello, everyone. We're just going to wait a second to make sure everyone who is in the waiting room is able to flow into the webinar. All right, so it is 11 o'clock, and I know some people are still coming, but they can flow in. We'll get started. So hello, everyone. Welcome to our second tax seminar of the year. Who we have presenting today is the same person that we've had presented at the other one, which is Bob Sproule. And Bob is a retired faculty member from the School of Accounting and Finance and has also acted as the accountant for the Graduate Student Association over the last 25 years. And he has been kind enough to also run these sessions over the last few years for postdocs. So welcome, Bob. Before I hand things off to Bob to relay all the really important information that he has to share with you today, a few notes. As a heads up, this session is being recorded. So if you want to go back and think about it and re-look at some of the material, we will be posting it on our website, the recording. And we also have tax clinics coming up. So as a person who has registered for one of the tax seminars, you would have been given priority access to the bookings, but I will be advertising those as well a few more times, and they will all be taking place in April. So keep an eye out in the Postdoc e-news for those if you have not seen the email come through. All right, so with that, I will hand things off to Bob.
Good morning, everyone, and welcome. As Ashley mentioned, in terms of my background, and I met Ashley a few years ago when she was a graduate student, and she was doing some work with the Graduate Student Association, and it was that relationship that sort of led to where we are today. So we're going to spend about an hour today, less than an hour, a little less than an hour. And the purpose of our time today is just to introduce you to the basics of income tax as it exists in Canada. There are, as Ashley mentioned, some other opportunities for you to hopefully avail yourself and prepare to complete your tax returns or get your tax returns completed through some clinics. And clinics consist of 15-minute time segments where I sit down with you on a one-to-one basis and answer your specific tax questions. And just to confirm, this service provided to you does not include the preparation of your tax returns. It simply is to inform you and hopefully support you in the context of getting your tax returns completed. The premise I'm operating under in terms of who you are and where you are at is that I'm going to be operating under the premise that you are a postdoc who has started your work with the University of Waterloo sometime in the year 2024, that you either relocated or commenced at some point, and so you have worked for the University of Waterloo for a number of months in 2024. And so as a result of working in an employment situation, you are required by law to file a tax returns, and I use the plural, because there are actually two returns that you file simultaneously. So let's get started. Next, Ashley. So what should you do first? Well, the first thing you should do, again, is have an understanding of how income tax works in Canada. So in Canada, there are two levels of governments that are empowered to assess and collect income tax from individuals. Both the federal government and the provincial government of the province you normally reside in, which we're assuming is Ontario, are the levels of governments who can assess and collect income taxes, and they use the income taxes that they collect from you to help fund the services that they provide to the population. Next, Ashley. How is your tax return submitted? Well, even though there are two levels of governments that are assessing the tax returns, you only have to submit one combined return, and that combined return will be submitted to the federal government. There is a department of the federal government called the Canada Revenue Agency, and you'll see the acronym CRA often, which contains a lot of information on both the federal taxes applicable to you, along with the respective provincial taxes. Some of the reporting is done in one document to facilitate reporting to both levels of government, while other reporting requires the same data to be reported in two forms. This structure is driven by different rules for each level of government. For instance, the basic personal exemption, which means the minimum threshold of taxable income that you have to earn before you are liable for income tax, differs. There is one amount that the Government of Canada has set, and there is a slightly smaller amount that's been set by the province of Ontario. Next, Ashley. As I mentioned, the Canada Revenue Agency, and there is their URL, part of their URL, canada.ca, provides a lot of in-depth resources to support you in completing your individual tax return. One of the documents that I strongly encourage you to spend some time going through initially is a document that's entitled Newcomers to Canada. The document, when you find it or go to it, is actually, the actual title includes Newcomers to Canada 2023. You won't find a 2024 version of this document because it was not updated, principally for the reason that nothing really changed in terms of the information contained in this document year over year. You can access this document, and I'm going to give you a little trail to follow by first going to the web, opening up a browser, and simply putting in canada.ca. Once you have input canada.ca, a page will open, and on that page you will see a number of links. And one of the links is simply the word taxes. You click on that link, and that link will then open up a page that will provide you with a lot of other links to other documents and a search bar. And the use of a search bar is something that you will find practically on every page throughout the Canada CRA website. In that search bar, you simply enter in the name of something that you're looking for, and I'm suggesting Newcomers to Canada 2023, and that will open up a page that will contain a PDF version and an HTML version of this document. So the first thing I'm suggesting you do is you navigate to this document, access it, and spend the time to read through it. What it will do is give you a very general overview of the nature of income taxes in Canada and how they work, and the types of income and the types of deductions that are the typical income and deductions that are covered off or you are responsible and accountable for in the context of filing your income tax return. Next, Ashley. So there are a couple of options in terms of how you complete your tax return. You can either complete a written return by determining what data needs to be reported on what documents, and those documents are available through the CRA website. The situation you would find in if you opted to take that approach would be to try to determine which specific schedules and which specific return you would need to complete in order to prepare a tax return for submission. I'm going to strongly encourage you, instead of of following that path to choose another path. And that other path is to use what's called tax preparation software. And the tax preparation software is very helpful and very user-friendly and very supportive in terms of completing a tax return. Suffice it to say that income tax, its operation, the rules that apply to income tax is somewhat complicated in Canada. Even for someone like you, who really, when you look at your tax situation versus someone like me, who has lived in Canada for all of his life, who has the number of probably half a dozen different sources of income, a number of different deductions, 10 or 12 different deductions. It can get fairly complicated quite easily. And even in your case, where your tax situation is fairly clear-cut and not complicated, still, you'll see that when your tax return is completed, it's going to be about a 20-page document. Next, Ashley. So once you complete your tax return, there are a couple of options in terms of how you file your return with the federal government. A hard copy of your tax return, along with required slips, and required slips are certain documents that usually come from an employer or a bank. They usually have a number and a letter associated with them. The letter is a T, which stands for taxes, and then you will find a 1 or 2 digit number after. Those T slips need to be, one copy of the T slip needs to be submitted with your tax return. And your tax return in and of itself is called a T1. That's the general tax return that you will complete that will cover off both your reporting responsibilities to the federal and to the Ontario governments that I mentioned earlier. There is another option in terms of submitting your tax return other than printing it out and mailing it. And that other option is to file an electronic version of your tax return. The service that supports filing your tax return electronically is called NetFile, Netfile. And you can submit your tax return using NetFile as part and parcel of the tax preparation software that you use. With the generation of a electronic version of your tax return, that is done through the tax preparation software program. It's a process that literally takes 2 minutes to complete, and you do not have to submit any documentation other than what is submitted electronically through the program. Regardless of whether you submit a return electronically or paper-based, you should complete all supporting, retain all the supporting documents for up to 6 years. And the reason for the 6-year time frame is that the governments reserve the right to come back to you for up to 6 years to query you in terms of some of the information contained in those old returns. That is not something that typically happens to 95% of the population who files tax returns. The only time that the government would come back in terms of requiring additional supporting information is if there is something really odd that's contained in your tax returns. In most cases, something really odd has resulted from an error that you have made made by accident. And it's probably been made by accident because you've been a little uninformed in terms of the sorts of information you need to include and where you need to include it in your tax return. Next, Ashley. So I think I've already supported and addressed this issue with you. you should use tax preparation software. It will make your life far more straightforward and far easier in terms of the time required to complete, and have a relatively safe perspective that everything that you've got in your tax return that's been prepared through the software program will be accurate and correct. You will find one of the things you can check, as I mentioned, there are all kinds of tax preparation software programs that are out there. The federal government has an interest in ensuring that any tax preparation software program that you use will provide the sorts of information that they deem necessary. And so one of the things they publish every year within the CRA site is a list of approved software packages. With the software packages, like a lot of software that exists today, you can choose when you access and use the software to either access and use a web-based version, or you can actually download the program, the software program, and do your tax return using that program. So I'm going to talk about two of the reliable and approved software packages a little later on in this presentation. But the CRA list, if you choose to access it, will have about 15 or so software packages that are deemed appropriate. Next slide, Ashley. Okay, are you eligible to file an income tax return? So here's the criteria that determines whether you are eligible. If you settled in Canada anytime during 2024, the year covered by the tax return, or earlier, that is one of the criteria that makes you eligible to file. I should also mention here that if, in fact, you didn't start your postdoc work in Canada, in Ontario at the University of Waterloo until January of this year, you don't have to file a tax return until a year from now. Tax returns reflect the situation concerning your taxes for a calendar year. So the tax return that is due now relates only to things that happened in the year 2024. Next. One of the other criteria is that you have something that the government called residential ties. And residential ties are very easy to establish. Having an apartment building that you are renting, therefore having your name on a rental agreement, having a bank account, or having a credit card associated with, or having a Canadian bank issued credit card is enough to basically create this thing called a residential tie, which is another criteria that supports you completing a tax return. Next, Ashley. One of the things that would have happened when you started in preparation for starting your postdoc work at the University of Waterloo would have been some paperwork, and that paperwork may have consisted of a social insurance number being issued to you. If this is the first time that you have come to Canada, was to basically start your postdoc work. A social insurance number is a 9-digit identifier. Everybody in Canada is issued a social insurance number when they first have employment income. And that social insurance number will be yours for your lifetime. And as I am suggesting, probably all of you would have completed documentation if you didn't have a social insurance number when you started your postdoc work, as part of the process that would have happened in terms of your department. They would have supported you in terms of filling out the document to have a social insurance number issued. That social insurance number will be used as a part of your profile in terms of anything concerning tax going further. And next, Ashley. As I mentioned, there are a lot of resources available through the CRA site for information on other reasons to file a tax return. So you take the time again to read the Newcomers to Canada document. And as I mentioned earlier, I talked about how you access that document. Next slide. So, do you need to file a tax return? Well, here are a list of reasons why you need to file a tax return. First of all, you worked in an employment situation, and that's a given at this point because you're all postdocs, and so you have income that you are earning from the University of Waterloo. And you have to pay tax if you exceed the minimum threshold requirements, which are close to $15,000 for income earned. Now that $15,000 figure I've quoted relates to a level of income for the whole calendar year. If you started your postdoc partway through 2024, the $15,000 threshold will be prorated based on when you started. So if you started in May, you would have been in Canada for 2/3 of the year, and 2/3 of 15,000 is, we can figure that out pretty quickly, is $10,000. And so on. If you started in September, you're only here for 1/3 of the year, that threshold income is $5,000. Next, Ashley. There are certain things that will basically entitle you to a refund. And one of the things that can happen is that you will have noticed that when you started to work for the University of Waterloo and you accessed your pay stub that provided information on the amount of money that was going to be deposited in your bank account, you noticed that that amount was not the amount of the salary that you earned. And that is because the University of Waterloo is obligated to withhold from your income amounts related to three things. And these three things apply to everybody who's in an employment situation in this country. One is income tax, two is Canada Pension Plan, or CPP, and three is employment insurance, or EI. So if you look at a pay stub for any pay period that you were paid for in 2024, you will see amounts for your gross pay, the amount of income tax, Canada Pension Plan, and employment insurance that were withheld, and the net pay that was put into your bank account. Usually the amount of the deductions that the university makes are pretty well spot on in terms of correct to the penny, but there may be some unique thing that occurred where the government, where the employer, the University of Waterloo, may have deducted a little more than what they should have. That will become flagged when your tax return is prepared. One of the things that the tax preparation software will do for you is when you input information on the income you made and the income tax, Canada Pension Plan, and employment insurance that were deducted, it may calculate that in fact the university might have over deducted from you. If that was the case, when your tax return is completed, it would come down to a bottom line saying a refund. And typically, if there is a refund, it's probably going to be a relatively small amount. In order to receive that refund, you need to file your tax return. Next, Ashley. Now, there's also a number of things called refundable tax credits. And these are a handful of programs that the governments in Canada have put in place to provide an opportunity for individuals who file tax returns to receive some additional funds from the government. They're, again, relatively small, just as a, I don't know, you call it an act of good faith, being somewhat supportive of you while you're here. And there are 4 refundable tax credits that all of you will have an opportunity to earn and be entitled to receive. And they include the following: HST credit, the Canada Carbon Rebate, an Ontario Sales Tax Credit, and an Ontario Rent Credit. You will find that when you complete your tax return, especially if you're using tax preparation software, as part of the process, the program will take you through some steps to gather some information to determine the amount of these credits that you potentially will be entitled to. They will determine how much you're entitled to, and that will be included in the calculation of your overall refund when your tax return is completed. Next, Ashley. There is one other scenario that can potentially have an impact on a refund, and this falls into the category of something that's called a non-refundable tax credit. So you can see the difference between this and the previous bullet, and that the non-refundable tax credit means if you qualify for this type of a credit, you're not going to be sent a refund per se. You will simply have the opportunity to apply this credit to your taxable income or your tax owing to reduce the amount. And again, this would be factored into the software program and would be included as part of the process of having it completed by the program, your tax return, that is. And I'm choosing to mention this here because there is one very significant non-refundable tax credit that typically is, I'll call it, floating around for any of you who did any of your academic program in Canada. So either as an undergraduate or a graduate student, if you completed a degree in Canada, in all likelihood, your profile at the time you completed that degree is that you paid some significant tuition and probably didn't have any or had a very minimal amount of taxable income. This would have resulted in you not being in a position to claim these tuition non-refundable tax credits that you would have earned throughout your program of study. If you were someone who did both an undergraduate and a graduate program, these tax credits are allowed to accumulate, unlike some other non-refundable tax credits that are not allowed to accumulate. And so oftentimes somebody who has done, again, some studies, university studies, may well end up in a position where when they finally finished all of their degrees, they may have a non-refundable tax credit, a balance that they have accrued of tens of thousands of dollars. In order to basically bank whatever tuition credits you had earned in a year where you were a student, you need to file a tax return. And in the process of filing the tax return, any carry forward of previous years' non-refundable tuition credits would have been carried forward by the program, assuming you're using the same program year over year. And basically the credits you earned in the current year would be added to the credits you had coming into the year. And that's how you end up in a position, as I said, with maybe potentially tens of thousands of dollars of credits. So the important thing just to note here, as I said, is this is something that applies if you did some studies, either at the undergrad or grad level in Canada. If you didn't, you can simply ignore the comments I've made regarding these non-refundable tax credits. Next, Ashley. There are some other programs that the government has in place to help you manage your income taxes over a number of years. So one of the things that exists with regards to income taxes in Canada is that income taxes are, they have a sliding scale in terms of tax rates. So as your level of income increases, the tax rate applied to that increased level of income grows over time, or not over time, sorry, over the dollar amount of income that you're reporting. And so the typical scenario for someone over their working career is that they finish their studies, they get a job, they start to work, they're promoted, they go work for other companies. And probably one of the reasons why they're going to work for other companies is they get a higher salary, and that carries on for their working careers. We could be talking about 20, 30, 40 years, and then they retire. And when they retire, they're typically, what happens is they're living on a pension or savings, and those pensions and or savings are going to be far less than the income they were earning in their employment years. And the government provides a program that basically allows individuals to defer the taxes paid on a portion of your taxable income to later years in your life. And the reason why you would choose to do this is that the tax rate applied to that income that you're deferring will probably be less because you will have a lower level of total taxable income. So in order to give you that advantage to defer the taxes you pay on some taxable income and also have the tax rate applied to the deferring, they have set up a program called a registered retirement savings plan. There are limits to how much you can contribute, and they are an excellent way to plan for your retirement. The other program I'll mention at this point is called a tax-free savings account, TFSA, and that is a program that will allow you to allocate or place money into it. That money would be money that's probably been subject to tax when you earned it. But once you put it into the tax-free savings account, any return earned on that tax-free savings account is not taxable. And that applies forever. So that's another excellent vehicle to use to minimize the total taxes that you will pay over your lifetime. And the last bullet, Ashley, there is also another specific benefit that I wanted to mention. It's called the Canada Child Benefit. And a Canada Child Benefit is a non-taxable credit that the government will give to you if you are supporting a child or children. In order to qualify for the Canada Child Benefit, both you and your spouse need to file tax returns, even if either you or your spouse have no taxable income in the year that you are applying for this benefit. Next slide, Ashley. Okay, what types of income are taxable? Well, I've talked about your employment income with the University of Waterloo, and all of you would have received a T4 for the income that you were paid in 2024. Also, other than the employment, if any of you were working outside of the University of Waterloo, either in a part-time capacity or you were working outside of the University of Waterloo prior to your postdoctoral work, you may also have T4s related to that work. Basically, any employment income that you earned in 2024 should have been reflected in a T4 that you received from your employer and should be reported in your 2024 income tax return. Next. The other type of income that a lot of you may have is what's called investment income. And this principally is income that is earned on money that you have invested. The typical investment would be you started your postdoctoral work, you had some savings, the savings may be just sitting in a savings account at a bank where they are earning interest, or you may actually be investing. And in the process of investing, you may be earning some dividends, or you may have some what are called capital gains if you've bought and sold some shares in a company in 2024. All of those types of income are taxable, and they will be reported on a different T slip, a T5 or a T3 slip. And they need to be reflected and included in your taxable income also. Next. Some of you, if you were doing or completing studies during partway through or for part of 2024, may have drawn some money out of something called a registered education savings plan. That money becomes taxable in the year it's withdrawn. That would be supported by another different T4 slip called a T4A slip. Next, Ashley. The other type of income that maybe some of you may have existing as part of your postdoc is you may have been awarded a research grant. That research grant is taxable and needs to be claimed. Now, the research grant amount, while you claim the total amount of the grant you received, you also can deduct any expenses that you incurred related to the research work. So that covers things like any lab costs you incurred, anything you paid to anybody you had you hired to do some testing or data analysis, covers the cost of going to any conferences where you're presenting a paper, and all the travel costs associated with the conference, the registration, the hotel, the meals, getting to the conference, if you had to drive or fly, all of those can be claimed and offset against the research grants. Next, Ashley. The one other type of income that you may have is if you were in a situation where you worked on a part-time basis in the hospitality business. And as you know, if you worked in the hospitality business, you probably earned some tips, especially if you were working in the front as a wait staff person. Those tips are typically paid to you as cash at the end of your shift. And there is no record from your employer in terms of the amount of tips that you received, but they are taxable. So if you were in that situation where you received tips, you should have kept a record of the tips that you received during the year, and you should be declaring that tip income in the tax return that you are filing. Next, Ashley. You may be in a situation where in part of the year, probably not including your postdoc time, you may have received a scholarship or a bursary. If you did, you would have received a T4A slip. However, the scholarship or bursary that you received, in fact, is not taxable. Even though you received a T4A slip, you do not have to declare the scholarship or bursary amount in your tax return. Next, Ashley. Now, for those of you that came to Canada in 2024, partway through the year, you may have received income from the country where you were working prior to coming to Canada. And that income falls under the umbrella of something called world income. And that income may or may not need to be included in your tax return, dependent on an agreement that exists between Canada and the country you came from. So many countries, there's probably 50 to 75 countries in the world that have entered into tax treaties. And it would be a treaty between two countries. And the treaty would cover things like income that may have been earned in one country that might need to be reported in the other country. So what you are what you are going to, or what you should be doing, is if you had income from a country other than Canada in 2024, you need to access the tax treaty agreement between Canada and that country and see what it says about the declaring of income from the other country in your Canadian return, and vice versa. The typical scenario would be that if you have to include the income from that other country in your Canadian tax return, you will be able to also reduce your taxes in Canada by the taxes you paid to that other country when you filed a tax return in that other country. The principle being what's deemed as fair, and fair being you should not be paying double the tax for the same amount of income. But again, I don't profess to be an expert on all the different tax treaties that exist between Canada and other countries. You can access the tax treaty that potentially applies to you through the CRA site, and you should, if this situation is a situation you are in, you need to basically go through that tax treaty and see what it says about the reporting of income. And the last bullet, Ashley, the other thing that potentially could trigger the requirement to include an amount in your tax return, your Canadian tax return, is if you happen to own property outside of Canada and before you moved here. And you may or you may not, for some unique set of circumstances, be identified in your Canadian tax return as having completed what's called a deemed disposition, where for tax purposes, it's deemed that you sold the property for the market value, the deemed market value of that property at December 31, 2024. And I'll just highlight, again, this is probably doesn't apply to most of you. If that situation exists, page 12 of the Newcomers to Canada document provides you with some information about how you deal with that particular situation. Next slide, Ashley. Okay, what deductions can you claim against the taxable income that you are declaring? The deductions include the following: the income tax, CPP, and employment insurance included on your T-slips. The Canada Pension Plan is a pension that is created for everybody who's employed in Canada. It's run by the government, and it is basically designed to provide you with some income after you retire. Employment insurance is a package, or is a benefit that's available for anybody who, for some set of circumstances in a given year, may find that they are not working for a period of time. They can basically access this insurance program that will pay them some funds to help support them during the time of unemployment. Deductions that are withheld for income tax, CPP, and employment insurance are included, and you can claim them in your tax return. Next, moving expenses. Moving expenses basically relate to the costs you incur to move to Waterloo to start your employment with the University of Waterloo. In order to potentially be able to claim the moving expenses, you have to have moved for, the move distance had to have been for over 40 kilometers. And basically you can claim as moving expenses all the costs you incurred in moving from where you came to Waterloo to start your postdoctoral work. And finally, the last deduction you can claim are childcare expenses. So these are for children that you support that are under 16, and they are basically daycare costs that you have paid out to have your child or children cared for while you are at work at the university. And the only thing that you need to be aware of is that the person who ends up claiming these childcare expenses should be the person who has the lower net income between you and your spouse. Now, next slide. non-refundable tax credits. Okay. So these are tax credits that, other than the previous comment I shared with you in terms of tuition, they are tax credits that you can use in the year you qualify for them, but you cannot carry them forward if you are in a position where you don't have enough income to claim the credit. They are used to reduce your taxable income to zero, but are not paid to you if they exceed the amount of your taxable income. Next, yes. So here are the specific dollar amounts for the thresholds that you need to reach before you are subject to income tax. The first amount is the federal amount. The second amount is the provincial amount. Next, Ashley. The income tax, CPP and EI, again, is a non-refundable except to the extent that maybe they have over withheld, which I covered off before. Next, Ashley. I've talked about the unused tuition amount, and that, as I explained earlier, is a non-refundable tax credit that has the caveat associated only with it that you can carry it forward until such time that you can use it. Next, Ashley. There's also an amount called the Canada Employment Amount, and this is an arbitrary dollar amount, $1,433, which the government says you can claim, and that dollar amount is to help offset the costs that you would incur in terms of supporting you in your job. So let's say you had to go out and buy some new clothes, or you had to buy some specific safety equipment because of the job you have. In that case, or you don't even have to provide receipts, you simply are given a credit of $1,433 that you can claim against your employment income. And that will be one of the things that will be automatically rolled into your tax return by the tax preparation software program that you use. Next, Ashley. Any donations and gifts that you make. The donations and gifts have to be to what's called a registered charity. Registered charities are registered with the federal government. You will see in any receipt that you receive for a donation that you made, if it would have a charitable number on the receipt, and that would indicate that it's registered. And those, and only those registered donations that you made, can be applied to reduce your taxable income. And next, Ashley. Medical expenses. So this is all of the out-of-pocket expenses you incurred, any prescriptions that you had filled at the drugstore. It also includes any insurance premiums that you paid for insurance, health insurance that is in place. So health insurance premiums plus actual medical costs incurred can be claimed as a non-refundable tax credit. And next, the Canada Child Benefit. Okay. If you have a child under the age of 18, you and your partner can apply for this credit. Next, Ashley. Under 18, as I mentioned, and as I mentioned earlier, both you and your partner have to file tax returns, even though either or both of you might have no taxable income. This credit is used to help offset the cost of feeding and clothing your child or children. And the amount of the credit that you will receive is dependent on your family's combined income, hence the requirement that both you and your spouse need to file tax returns. The lower your combined income, the higher the benefit paid. And there's information available in terms of how you apply for this child tax credit through the CRA website. Next slide, Ashley. Oh, yes. Yes, sorry. Okay, so now we've got you to the point where hopefully you're somewhat comfortable in terms of going forward and working your way through a your tax return. So you can, again, as obviously I've suggested, I strongly encourage you to use tax preparation software to manually complete your return, and the tax preparation software you use is one that is approved by the Canada Revenue Agency. Next, Ashley. Let's go to the next point. Ashley, I think I've covered that up. Okay. Yes. The basic premise of the tax preparation software program you use is that it works like any other tax software or any other software. You may or may not have to pay for the return that you prepare, and that amount that you have to pay is dependent on basically how the tax preparation software is, how the vendor, the seller of the tax preparation software likes to treat their product. Normally, tax preparation software will say that you have to have a taxable income above a threshold, and that threshold is typically $20,000 before you are subject to pay for the tax return that you have completed. How the tax preparation software works is when you go and you purchase the tax preparation software, it follows a typical protocol. You create your own account, you create your own password, and again, that then becomes yours for the duration that you have that software and continue to use that software. What the tax preparation software program will do is once you have created your login and password, it will build a profile for you. And that profile that it builds for you will take you through a series of prompts where, first of all, they're going to ask you about the sources of income that you should be reporting, then the sources of deductions you should be claiming. And once you have populated that profile along with personal information, your name, your social insurance number, your address, it will then ask you, do you want to complete a tax return for your spouse at the same time? My answer would be yes, you should. If you're in a situation where you are married, you should complete both returns at the same time. There are reasons to do this, and the principal, probably the clearest reason, is in the context of qualifying for the Canada Child Credit. You need to report, and each of you needs to file a tax return, and it's a lot easier to do it simultaneously as opposed to completing one tax return and then completing a second tax return. The other thing that the tax preparation software will do is it will allow you to basically to minimize the total tax you pay between you and your spouse. So it may flag when amounts are reported for each of you and your spouse that you have the opportunity to allocate, for instance, the charitable donations or the medical receipts to the spouse that would have the highest tax saving realized from the use of those credits. And it will do that for you through a series of prompts. It's going to say, in the context of completing your return, do you wish to rebalance your medical receipts without explicitly saying to minimize the total tax paid or the total benefit, maximize the total benefit that you can receive between you and your spouse. So you potentially can choose to complete a spouse's return at the same time. Once you have built your profile, it will then take you through a series of screens, asking you to enter information from boxes. Every box on a T-slip, you notice, will have a number. It will prompt you to enter the amount in a box with a certain number in the screen that you are looking at. It will take you through a series of screens to have you first enter in all the income, then enter all of the deductions, and then calculate the bottom line net amount, either a net refund or an amount owing, and also identify certain credits that you qualify for. And this will all be part of the process of the completion of your tax return. It will also, when you basically have said, I have everything in, it will also review your tax return, identify anything that they know is an error in terms of an amount that maybe you put in a wrong box. They'll flag it. They'll tell you that you have to fix this error before you can complete your tax return, or can identify what they call a series of warnings. And they're simply opportunities that you may have to change or add some additional information that would have a potentially positive impact on your bottom line. The other thing that this bullet makes reference to is something called autofill. As I said, once your profile is built, the tax preparation software will take you through a series of screens and ask you to enter in amounts. The amounts it will ask you to enter are from the various T-slips. They also provide you with an opportunity to autofill, which means that instead of you having to put amounts from the various T-slips onto a screen, it will populate a screen automatically, and it'll populate the screen based on information in T-slips. And it can do that because for every T-slip that is prepared, whoever prepares that T-slip has to send a duplicate to the federal government. So the federal government has T-slips that for every employee employed in 2024 and all the other information in terms of other sources of income, other types of deductions, and the tax preparation software can access those T-slips that the government has in order to populate your tax return. Next, Ashley. Now, when it comes to mailing in your tax return, you need to, if you're mailing it in, you need to include copies of all the T-slips. And the other thing I'll mention is that, as I suggested, of the approved software preparation programs, there's two that I will recommend that you can choose between using. One's called UFile, U-F-I-L-E, and the other one's called TurboTax. They've been around, both of them have been around for a number of years. Both of them follow the same protocol that I outlined, and both of them are reliable, and they will do accurate calculations based on the information that you include. Good data in means good data will come out. Next slide, Ashley. Now, for any of you who have a social insurance number and also have your date of birth on file, and that date of birth on file should have been part of the process that occurred at the time that you were set up with the social insurance number, you can file your return electronically using this thing called NetFile, which is part of the Canada Revenue Agency. Basically how NetFile works is that all of these tax preparation software programs that have been approved by the Canada Revenue Agency will provide you with an option after your return is completed, there's no critical errors, to submit your return electronically. And it, as I said, takes about 2 minutes to submit a return electronically. It will generate your tax return in a certain format that will be accepted by the CRA, and you simply go through and respond to a few prompts in terms of the filing electronically, and the return is filed electronically, and you are done. Next, Ashley. Whoops. There is a due date that's associated with the filing of the tax return, and the due date is April 30th. The April 30th date is only critical if you are in a position where you owe money. If you owe money, the federal government requires that that amount of tax needs to be paid prior to April 30th. And you can make the payment. There's a number of options that are identified through your bank, either going to your bank, or you can make an electronic payment using, I think, the bill payments function, and setting up the CRA as a payee. If you have a return, the date of April 30th isn't that critical, because basically the government owes you money, and they would prefer that you either didn't file or filed late, because they get to keep your money for a longer period of time. Okay, and next, Ashley, I mentioned about the 6-year. Oh, sorry. How long does it take? If you send in a mailed copy, mail it in, return, it's going to take 10 weeks for it to be processed by the Canada Revenue Agency. If you submit your return electronically using that file, it takes 2 weeks. What happens is that after the government has processed your return, they're going to issue what's called a notice of assessment. That's acknowledging that they've received your return. They have looked at the numbers, key numbers on your return, and they're telling you that based on their cursory review, they are satisfied that you have included everything that you needed to include and everything is okay. And they will either say that they agree with the amount, the bottom line amount, either the amount that you owed and paid, or the refund that you've qualified. And if you've qualified for the refund, once they've completed your assessment, they will get that money to you, and they will get that money to you because they will want to deposit, or by depositing it electronically into your bank account, and you will have provided notice. You will have provided banking information as part of your tax return, so that they know where to deposit that money. Okay, Ashley, next. And the only other thing that I've talked about, the notice of assessment. The only other thing that you should be doing on a first time basis, the first time you file a tax return in Canada, is you should be going through the process of setting up something called My Account. That is basically a portal that exists and provides some basic information about you and about your tax situation with the Canada Revenue Agency. It provides a quick access for you to go back, and you can look at all the T-slips that have been filed by third parties for any year. It will provide a record of your notice of assessments and other information. And again, if you go to the CRA website and you search My Account, they will tell you about all of the things that you can manage with your My Account once you have created it. In order to create your My Account, one of the things you need to do is you need to add what's called an access code. And an access code is I believe it's a 6-digit numeric code that will appear up in the top corner of your notice of assessment. So you can't create your notice of you can't create your My Account until you have received your first notice of assessment. And then once you've received it, you should create your My Account to help manage your ongoing communication with the Canada Revenue Agency on a go-forward basis. Things like moving, change addresses, or banking information, you would update that through your My Account site. So that is it. I'm just over noon. Thanks for your patience. Any questions anybody wants to ask now?
Thanks so much, Bob. I do say that there is one question. It looks like says, thanks for the talk. As I moved to Canada in December 2024, but start my postdoc in January 2025, when should I claim the moving expense tax credit? Can I claim it next year?
Next year.
Next year.
Yep.
All right. All right. And so I'll mention, if anyone else is typing into questions, that we do have those tax clinics coming up on April 1st, 14th, and 23rd. You're going to see them pushed out in the Postdoc e-news over the next week or so. So the next postdoc e-news will come out on April 1st, but most of you already received an invite to at least that first tax clinic session. So these are one-on-one 15-minute consultation sessions with Bob that you can ask like direct questions. The only requirement really is that we ask that you have attended one of these seminars, which you have done already by coming to today. So I'm not seeing any other questions popping up, but I know some of our postdocs have gone off to other things. But thank you so much, Bob, and thank you so much for all the postdocs that have come in today to listen to the session. Again, this was recorded. It will be posted on our website if you want to go back and review some of the information that Bob has shared today. And again, keep an eye out for those clinic spots.